Good evening, Binantians, and welcome to our official Futures AMA session. AMA, for those of you that do not know what it means, that is Ask Me Anything. Today, we are going to be joined a little bit later by Jack from the Futures team. He will be here to answer your Q&A, your questions that I do not understand personally. He'll be here to assist me with those harder to understand questions, those more in-depth questions, those very complicated questions that we always seem to get in the chat. This AMA does have two segments to it. We're going to start off the AMA with a few commonly asked questions, answers, stuff that the community has been asking and we have taken note of, and we'll be answering those first. We'll then go into a live Q&A session. This is where you are able to drop your questions in the chat. We will get to them. We will answer as many of them as we possibly can in the time frame that we have. As always, if your question does not get asked, feel free to pop it on the Telegram group. I am on the Telegram group. Jack and Mr. B are also going to be on the Telegram group, and we'll answer more of your questions there if we do not manage to get to it during the course of this event. But welcome to everyone in the chat. I'm going to give a few shout-outs. Welcome Sakuragi, Brian, It's Baked Mike, Ibrahim, Naties Valley, Bulls, Ibrahim, Kings Media, Ezabunwa, Abubuka, Mukhtar, and GR Police. Yes, guys, unfortunately, it is load shedding in South Africa at the moment. So if you do hear my UPS beeping in the background, please don't think someone's trying to phone you or you've received a WhatsApp. Unfortunately, it is just my UPS going off non-stop. As we know, South Africa loves to cut off our electricity. But without further ado, we are going to go through a couple of rules for this AMA. Guys, please no bot fake accounts watching. We do know that people try to do this to win prizes, etc. Also, no copy-paste questions. Please, if you see someone else asking a good question, don't copy-paste constantly. If you have your question and you do not get answered immediately, please don't just keep posting and posting and posting over again. We will get to the questions in due time. We will answer them when we get a chance. Also, only one question per user for the start. Once everyone has had a question, we will move on and then answer some more questions if we have some more time. But please respect the rules. I don't want to have to kick anyone out of the chat. That is not something I enjoy doing. I love educating you guys. I love educating myself at the same time. So let's get into our AMA. This is our first AMA session of 2023. Today's topic is going to be learning more about futures with Binance. Binance obviously being the biggest crypto exchange in the world, and myself being from Binance, and Jack, who will join us later, also being from Binance, will be our guest speaker. He's from the futures team, and he will be answering, as I said, those in-depth Q&As that you do have, all those in-depth questions. Just for a quick ground rules, this AMA session, before we kick things off, our first segment, as I said, will be a sharing session. That is information we have to give to you guys. The chat is muted. Unfortunately, this isn't a live Telegram talk, so don't worry about that. But once we open the AMA or the question section later, please then ask your questions in the chat. We will go through them. We will also be joined by Jack, as I've said many times. And let's begin. More on that later. Let's begin with the simple, easiest question that anyone will ever ask you. What are cryptocurrency futures? In the crypto industry, the future market is a fast-growing sector that generates trillions in volume monthly. Yes, guys, not millions, not billions, trillions. Like stocks, options, or commodity futures trading contracts, crypto futures offer protection against volatility and adverse price movements on cryptocurrencies. A crypto's future contract is also a proxy tool for investors to speculate on the future prices of cryptocurrencies. It can also be used to hedge against price changes of cryptocurrencies. That's just a brief description. As always, if you do want more information, we do have our Binance Academy, which has many lovely articles on it. There are many on futures, but that is the gist of what cryptocurrency futures are. Very similar to your normal stock futures, just on the cryptocurrency side of things. Our next question, we get asked a lot about the community, by the community. What are the differences between futures and spot trading? There are simply 4 differences between the two. Those being leverage, flexibility to long or short, liquidity, and futures versus spot prices. Let's take a deeper look into these 4 differences between futures and spot trading. We are going to begin with leverage. What does leverage mean, and how does this make it different to spot trading? Leverage makes futures trading extremely capital efficient. Hold on to that word, guys, capital efficient. With a futures contract, you can open up one BTC futures position at a fraction of its market value. Spot trading, on the other hand, does not provide leverage. If you want one Bitcoin on spot trading, you're going to have to buy one Bitcoin. You can't leverage a certain amount to buy more. For example, to purchase one Bitcoin in the spot market, you would need thousands of dollars. Assuming you only have 10,000 USDT available, you can only afford to buy 10,000 USDT worth of Bitcoin in this case. That is when you are on a spot market. When you are on a futures market, you can use that 10,000 USDT to buy Bitcoin and leverage that Bitcoin at a fraction of its market value. So not using the entire market value like some people do. Then we're going to move on to our second difference. That's flexibility to long or short. If you hold cryptocurrencies in the spot market, you may benefit from capital appreciation as the value of your cryptocurrency rises over time. In the opposite angle, you might have capital depreciation over time. This also applies to futures, but we know, guys, markets go up and down. They don't just continuously go up, because Einstein discovered, I think it was Einstein a long time ago, what goes up must come down. It wasn't Einstein, it was someone else. I'll get that right eventually. Futures contracts, on the other hand, allow you to profit from short-term price movements in either directions, price fall or price raises or price rises. So it's not like you can only lose your money. You can bet on the price falling. You can go with the price raising. Futures contracts can also be used to protect against unexpected risks and extreme price volatility, making them ideal for miners and long-term investors. So when we talk about price volatility, that is when we see, for instance, Bitcoin go up 50%, drop 40%, go up another 10%, then go sideways for 4 weeks, then up, down, left, right, backwards, and forwards. Futures can help you to negate or protect you against the unexpected risks of that. The third difference between futures and spot contracts would be liquidity. The crypto futures market provides deep liquidity. For example, the Bitcoin futures market has an average monthly turnover of $2 trillion, surpassing trading volumes in the Bitcoin spot markets. So let that sink in, guys. There is more monthly turnover in futures Bitcoin markets than Bitcoin spot markets. That shows you a little something. Its robust liquidity promotes price discovery and allows traders to transact in the market quickly and efficiently. And then last but not least, the fourth difference, futures versus spot prices. Cryptocurrency prices are determined by buyers and sellers through an economic process of supply and demand. You want bread, I need bread. That is supply and demand. The spot price is the ruling price for all transactions in the spot market. On the other hand, the futures price is based on the prevailing spot price, including the futures premium, which could be either positive or negative. So is a premium on futures can be either positive or negative. A positive premium indicates that the futures price is higher than the spot price. Conversely, a negative premium indicates that the futures price is lower than the spot price. Changes in supply and demand may cause the future premium to fluctuate. So, guys, we'll go through those again. There are 4 differences between futures and spot trading, those being the ability to leverage, flexibility to long or short, liquidity, and the futures versus spot prices. Moving on to our next commonly asked question, that is, are there any benefits to trading futures? There must be, or else nobody would be trading them. I'm not going to trade something that doesn't benefit me. If I'm using my money, my hard-earned money, I'm not going to trade something that does not benefit me. So let's take a look at 4 differences or 4 benefits to trading futures. These 4 benefits include flexibility, leverage again, liquidity again, and portfolio diversification. We'll take a deep dive into each of these 4. Let's begin with flexibility. Non-crypto holders can speculate on the price of cryptocurrency and make quick profits. You can open a position in crypto futures contract with stablecoins such as USDT or any cryptocurrencies, and any profits made will be settled in the currencies you selected. So, guys, whatever currency you select, if it's USDT, if it's BUSD, if it's Ethereum, Bitcoin, whatever, your profits are settled in that same cryptocurrency. That is the flexibility part of futures. The leverage part, the leverage benefit, as mentioned earlier, you can gain significant exposure to a specific cryptocurrency with only a fraction of its total cost. With leverage, you can magnify small price movements to create profits that justify your time and effort. A lot of people trade futures to make money quickly. It is part of futures. You can do it that way. You can do it long. You can do it short. But remember, there are always risks inherently involved. We did speak about this in our Telegram talk 2 weeks ago. So when doing stuff like trading futures, always make sure not to put your whole portfolio into one contract, for example. Diversify your portfolio, have a trading plan. Don't buy on emotion, don't sell on emotion. Always do it mathematically. TA is what we call it, technical analysis. All these things, use those to make sure that you aren't getting, you do know the risks at the end of the day. So make sure, use those steps. I will put them in the Telegram group again. Make sure you mitigate the risks because, guys, futures, spot trading, anything where you are trading, there is always an inherent risk involved with these types of things. Moving on to our third benefit, it is liquidity. Many think a liquid market is very risky, but actually a liquid market is less risky because traders can enter and exit their positions with minimal slippage. When we talk about slippage, anyone here ever bought a token on PancakeSwap, for example, and it is a new token that doesn't have much liquidity behind it, and you spend, for instance, $1,000 on this token on PancakeSwap, and now you have to put 15% slippage because of the liquidity problem. That means for every $1,000 you are buying of this cryptocurrency, you're actually losing $150. When it comes to futures trading, because of the vast liquidity pool, the slippage is much lower. Sometimes it can even be nothing. So it's a big advantage, much bigger liquidity pool. You never, or you very rarely see high slippage. You will always see minimal slippage in a futures market. Moving on to the last one. This is one I just mentioned as well in the trading plan, portfolio diversification. Futures trading allows for diversification across trading strategies to generate more profits. You can develop sophisticated trading strategies such as short selling, arbitrage, pairs trading, etc. So there are many different options when you are trading futures. It is not just buy and sell. You can do a lot of trading strategies, as I said, short selling, arbitrage, pairs trading, a lot of ways to diversify your portfolio. With that being said, that is the sharing part of this session done. We are now going to move into our comments. We're going to check if there are any questions, anything that needs to be answered. So guys, we are open now for questions. So if you do have any questions, please feel free to mention them in the comments. I'm going to invite Jack to join us. I'm not sure if he is with us yet. I will invite him to join us. And then we will go through the Q&A part of this call. Jack, are you there?
Yes, Doc. Can you hear me?
Yes, we can hear you. Welcome to the chat, everyone. This is Jack from the Binance Futures team. He is our expert for the evening. So if you have any sophisticated questions, please do ask Jack while he is around. He is here to answer your questions. That is what he's here for. I'm going to quickly look through the chat and check if there are any questions at the moment. Jack, would you like to go through our recently launched campaign? I can pull it up on the screen if you'd like to speak to the community about that first while I get up some questions for us.
Sounds good. Pleasure to join you guys. So we want to kick off the year with a promotion campaign specific for South Africa users. So this campaign will consist in two rewards. First, it's double your deposit. So you can deposit 5 USDT once you open your future account if you have never traded. And as a reward, you'll get 5 USDT as a free voucher that you can use to trade on futures. So it's a good way for you to get acquainted with futures, to make your first trade, to pretty much play around and understand how it works. And the second reward will be if you trade a volume of 500 USDT, you'll get an additional 5 USDT bonus reward. So this may, if you're not familiar with future, trading 500 USDT may sound a little high. However, it is actually not high at all if you use leverage, right? So as Doug mentioned earlier, the specificity of future compared with spot is that the ability to use leverage, so really to magnify your profits or losses, by the way. So with that in mind, you can trade a higher volume, much higher than spot, by opening and closing your positions, basically. So those are our two promotions, and for the ones that already have a future account open, but I have never traded, then there's automatically a free voucher of 5 USDT that is available for you, so you can also start trading without the deposit requirement. So I
yeah. Sorry, Jack, I interrupted you there.
No. I think the page, the event page, we will share the event page later on, maybe via on the AMA chat, or. But anyways,
I'll share it on the AMA chat and on the Telegram channel. So guys, if you want to look into that event, I'll share both links on this live stream and also on the Telegram group. We do have a few questions coming in. Jack, I can personally say I won't be able to answer these. I don't know if you will. But Eza Bunwa is asking, why can't I lower the leverage on one of the positions under isolated margin mode?
Okay. I'm looking it up. Sorry. Yeah. Okay. So basically, the leverage. So there's the specific rules for leverage whether you go on isolated mode or on cross margin mode, right? So I believe I'm actually not sure about this, right? I need to double check, but I believe that it's a risk measure. And you're going to need to close your position before lowering your leverage and opening a new one. And you cannot do that whilst a position is open.
Perfect, Eza Bunwa. Yeah. Hope that answers your question. I'm going to go through the questions very quickly. There are a couple of them, Jack. The next one is going to appear on screen. There's a maximum number of orders for each future. Which action should I take? I'm not sure what the question means, but can you elaborate more on why there's a maximum number of orders for each future?
I believe so. So from what I understand, the question refers to the limitation in terms of sending orders per minute. So we have limitation, especially with API trading, to limit the number of orders that can go through within a limited time span in order to avoid network congestion and server congestion, basically, to make sure that the latency is optimized and that all traders are able to place orders. So we have rules in order to block sending too many orders. And that might be what the question refers to. And in that case, if you're under that rule, you have to wait before placing a new order. Whenever you see a message popping up saying that there's the order failed because of the network or the server, you just need to wait and try again, basically. Not sure if that answered the question. Bells, feel free to elaborate if I didn't answer it correctly.
Perfect. Our next question is coming from King's Media, and he is asking, how long can you hold Binance futures?
So it depends. It really depends which kind of contract you are trading, right? So you have two types of different contracts. You have delivery contracts and perpetual contracts. So delivery contracts are just mirroring the futures contracts that are available in traditional finance, right? So you're going to buy, for instance, a BTC USD contract with an expiry date of usually it's quarterly. So usually it's going to be 3 months after the contract was listed, which means that at expiry, the contract, your position will automatically close and will be settled, right? So this contrasts with perpetual contracts that don't have delivery dates, right? And this is actually a specificity in crypto. This kind of perpetual futures with no delivery date have something specific, which is a funding rate, making the contracts, the spot contract, and ensuring basically that the spot contracts and the future contracts don't diverge too much. Because in the case of traditional contract with expiry, automatically at expiry, you're gonna notice a convergence between spot and futures. Most of the case, at least it happens, which is never the case for perpetual futures. So this is the difference. If you open a position using perpetual futures, you can hold that position indefinitely unless you get liquidated, right? So you also need to ensure that you have sufficient margin to keep your position open, whether it's a long position or whether it's a short position. Once you open delivery contract, your contract will automatically settle at expiry. So at expiry date, and the expiry date is basically mentioned in the name of the contract symbol, right? So this is a good way for you to forecast the date where in which your contract will expire.
I hope that answers your question, Kings Media. We have a few more questions. We got a bit of time. Fraul Barakat is asking, what is the fee while futures trading? Are there fees on futures? What is the fee?
Okay, the fees, I believe it's 0.02% per transaction. We have recently changed them, but yeah, it's around 0.02% of trading fee, right? So this is a source of revenue for Binance, is trading fees, and for most crypto exchange. We're trying to be extremely competitive there. We believe we are amongst the lowest trading fees in the industry. But yeah, I'll share the link to the latest trading fees to make sure that it reflects this number.
Perfect. Thank you. It's Bake. Mike has a question. I'll answer this one. Taxes, how are they handled in South Africa? Mike, I would suggest consulting a tax professional. Binance does not give tax advice. We are an exchange. We are not a tax firm. So I would say consult a tax professional or a local tax consultant and get them to tell you the intricacies. We do not give tax advice. Unfortunately, we are not a tax firm. Next question, moving on, is from Abubuka. I hope I pronounced that right. What's the minimum amount he needs to hold to start a futures trade?
Minimum amount is so you're gonna have a minimum margin requirement whenever you need to open a futures contract. So I believe you can open a contract with a couple of USDT. I couldn't tell you the exact number because it depends which contract you're gonna open, right? But I believe with as little as 3 USDT, you can open a futures contract. You can open a position.
So basically, it depends on the contract you are opening, and there are ones that you're saying minimum. You can go as low as 3 USDT to open that contract.
Yeah, even lower than that, I believe, for some contracts for BTC USDT, I believe with 1 USDT, you can try to open a position, actually.
Perfect. I'm just going to remind chat, unfortunately, if you do have questions unrelated to futures, please pop them in the Telegram group. We all will answer those there. This is the Futures AMA, so we're going to keep the questions relating to futures. This is a good question. I have put it up on the Facebook a couple of times. What are the USD margin futures and coin margin futures? What are the differences?
Yeah, that's actually a very, very sensible question. So to put it very simple, USD margin, so we call it USDS margin futures. It's basically contracts that are collateralized and settled in stable coins, right? So what I mean by collateralized is that you can use any stable coin as collateral. So USDT or BUSD. So any of those two. That's the reason why we call that USDS, because it encompasses USDT, BUSD. So you need to have that in your USDT margin wallet as a collateral in order to start opening positions in your future USDM account, right? So this is the first thing. Whenever you are making profits, then or experiencing loss, This will be settled, UPNL will be settled in USDT or UOB USD, right? But you mostly will be USDT for a USDT denominated contracts. And this is extremely handy in order to calculate, to forecast your profit and losses, because everyone think in USD. You don't need to convert any other asset in USD. And it is contrasting, of course, with coin margin. Coin margin is the opposite. So basically, you open your position using coin that are supported in your coin margin wallet, like for instance, BTC, ETH, ADA, Matic. And those tokens will be used as collateral, and your profit and losses, your P&L, will be denominated in coins, right? So those two different contracts are so whenever you open a position in CoinM or in USDM, your margin will be separated, right? So you have a dedicated wallet for CoinM and a dedicated wallet for USDM, right? So you don't share margins across those. And the strategy, the reason why people use CoinM or USDM is because the strategy you employ in both are very different, right? So as I mentioned, USDM, extremely convenient for you to calculate and forecast and simulate your profit and losses, right? You can calculate your return in flat super easily. And also in period of high volatility, when you trade USDM contracts, it will help reduce the risk of large price swings, basically, because your collateral is in stable coin. So the value of your collateral will stay constant, right? It will not move unless, of course, USDT depeg, which is always a risk, but it's extremely, the probability of this is extremely low, right? So the difference, so your margin will be in stable coin, so you won't get liquidated if the value of your collateral decrease sharply as a result of a market downturn, basically. On the other end, I'll just cover CoinM. CoinM is good if you're long on a coin. For instance, if you have Bitcoin, if you're long Bitcoin, you can use your Bitcoin to collateralize your position in future. And you do not need you do not need to sell your Bitcoin to get USDT to collateralize your position. So you're exposed to the Bitcoin price increase using it as collateral. So those are the main difference and the main reason why people use CoinM or USDM.
Just also on that note, if I'm not mistaken, you're also exposed to a decreasing price in Bitcoin. So there's the upside and the downside.
Absolutely, and you're right to remind that, Doug. That's the risk in CoinM, is that the value of your collateral can decrease. So if Bitcoin price decrease by 100%, for instance, your collateral value will decrease by 100%, and your position may get liquidated.
Okay, perfect. We're going to answer a few more questions. We have one from Samuel. What are the things to look for as a newbie when considering futures trading? I'll start this one off. The best thing you can do is have a trading plan. Don't just go in, and I use this term often on the Telegram group, willy-nilly, I'm going to buy this and see what happens. Have a plan. See what you think is going to happen in the future. Analyze the graphs. Don't just buy what you feel like. With futures trading, there is risk. So try and mitigate that risk a bit with the trading plan. Jack, if you have any other suggestions for a newbie when considering futures trading.
Yes, no, this is extremely relevant. You really need to follow a plan. Don't trade with your emotion. I would say study. It's more advanced. So read about futures. Watch videos of traders trading futures. Get information about that, because you can. And my piece of advice, right, is that you have access to high leverage when you trade future. I would really advise that be careful with leverage. Don't use super high leverage when you start trading future. Otherwise, you are extremely likely to get liquidated. This is very tempting because obviously, if you use like, I don't know, 100x leverage, you're gonna think, okay, my profit could go super high. You feel like this would be your luck, but a very slight decrease in the market price could get you liquidated very, very fast if you use a high leverage. So I really recommend using a very low leverage at first, at least until you get very familiar with future, you have your strategy set up, and you're an more experienced futures trader.
Perfect. Abu Buka, I think that also answers yours. What are recommendations for first-time futures traders? I'm just going to hop over to the Telegram group quickly. We have a question on the Telegram group. What is the difference between futures trading and options trading? I myself do not know the answer to that.
Okay. So this is really, really interesting question. So futures are a product that basically describes. So futures and options first. I go over the similarity, right? Those are derivative, meaning that you do, as opposed to spot, you do not own the underlying that you buy, right? So if you buy, let's say, Ethereum on spot, you actually own the Ethereum that you buy, and when you buy a derivative, you actually buy a contract allowing to buy or sell this cryptocurrency at a later stage, right? So when you buy a futures contract, you buy the right to purchase or to sell the assets at a futures date. Okay, so that's and same when you buy an option. But the difference between option and future is that when you buy an option, you buy the right to buy a cryptocurrency in the future. So we call that a call option, or you buy the right to sell this crypto asset in the future, and we call that a put. Okay, those are, remember, call and put. Options are either calls or either puts. And the difference with future is that you have the choice, but not the obligation to buy or sell those cryptocurrency. Whether in future, you are obligated to do so. So this is the main difference between those two types of contracts, right? So option gives you, basically, it's less risky, right? Because whatever the market does in the future, you are not obligated to buy or sell, right? You can just say, okay, I won't exercise my right to buy or sell at expiry. But in any case, you buy what is called a premium to buy the option contract. Of course, it doesn't come for free, right? So you're always going to need to pay a premium price when you buy an option contract. I hope
that definitely answers the question. It educated me quite a bit.
Sounds good. Yeah, and FYI, Binance released the options trading, European options trading on earlier last year. So those are European options. So it's actually it's different from future, but it's also a very interesting scope. So if you're interested in options, we will also host futures AMA covering options. So just follow our socials. So we will announce that in the future.
You're glad to hear it. Moving on to a few more questions. When you mean premium positive and negative, does that mean the spot value and the future value of a coin have a very big margin?
Premium positive and negative. I believe Fraul talks about the funding rate. I mentioned earlier that in the case of perpetual futures contracts, you have no actual expiry date, so there's no convergence between spot price and futures price, right? This is the concept of convergence. And in order to ensure that the price of spot and futures are still in line, there's the funding rate. that is a fee. So it's called a fee, a funding fee actually. It's a fee that is paid either by long holders to short holders, or vice versa, in order to incentivize some traders to go long or some traders to go short, depending on whether spot price is above future price, or respectively if spot price is below future price, right? So the premium is a part of the funding rate. So the funding rate is actually composed, it's a formula including the premium price, and premium can be positive or negative depending on how the market is on this relationship between spot price and futures price, right? So this is, I know this sounds a bit complex, and it is actually a bit complex, but this is very interesting to consider when you trade futures, perpetual futures, because it's extremely specific to crypto and to this type of contract. And a lot of traders do what is called funding rate arbitrage, which means that they open a position in futures, and they hedge this position by opening an opposite position in spot in order to collect the funding rate, this funding fee, basically. So this is an elaborate hedging strategy. It's called a delta neutral strategy, because you're opening two positions that are opposite in order to collect a fee at the end of the day, right? And we are about to release a trading bot on futures. I think the ETA is in a few weeks, allowing traders to automatically do some trading fee arbitrage. So it's going to be quite interesting. Yeah, I hope that answered that question. It's quite a complex concept.
I'm pretty sure it does. There are two more questions I found in the chat that I am going to read out. One of them is not so much a question, it's more a statement. And I get this a lot in the community. It's more the end part for me. For me, trading futures can be scary. There is a stigma that futures is so complex, so scary. I was wondering, Jack, if you could give a little bit more detail as to, it's not actually as scary as people think it is. It's not as technical as people think it is. And people shouldn't be scared of futures. They should just know the risk of futures.
Yes. I think people are usually scared about what they don't know. I do think that futures is definitely more risky, right, than spot, because of what we mentioned before, because of that possibility to use leverage, right? So as long as you trade within your risk appetite, right, and you're in line with your strategy, you don't put too much you don't actually put emotion on trading, you shouldn't be scared of trading future, right? But I'll be very clear here. Like, if you don't have, if your risk appetite is very low, you shouldn't trade future, right? Very straightforwardly. I think futures is risky because of leverage. Using leverage is risky. You have to keep in mind that trading is a lot of traders lose money, and I really want to emphasize on that. So you should never, if you're scared, if you risk adverse, I don't recommend trading future, actually. However, it is a fascinating product once you start learning about it, because the potential, it gives you a lot of potential. It can magnify your profit if you use it correctly. It gives you much more options in terms of what you can trade and the amount you can use to trade, and it gives you a potentially bigger exposure to some contracts. So studying this is extremely interesting. And if you want to learn about trading, if you want to be a more experienced trader, I really recommend getting into futures and learning about it, because you can employ various strategies once you're familiar with future, including the strategy I just mentioned, delta neutral hedging strategies with spot, and many others, right? So yeah, I definitely look into it, learn. You don't have to trade right away. You can also use the testnet environment, Binance test environment in futures. I believe it's available in South Africa to train yourself first without putting your capital at risk. I actually advise doing that at first until you get more comfortable with those contracts.
Perfect. And our last question we're going to take for the evening is, what is the difference between mark price and last price in futures?
Aha. Okay. I was hoping you would pick that one, Doc. Okay. So it's very it's also very specific to futures, right? So last price is essentially the price of the futures contract. Whenever you see look at the Binance trading interface, you have the last price. So it's basically what the market decides. It varies extremely quickly since crypto is very volatile, right? But it depends on the order book, right? So the last price is directly resulting for bid and asks on the order book. So it's decided by traders in the market. The mark price is actually a price that is generated that takes into account the last price. So an average of the last prices over a given period of time in the past, and an average of the spot index price on different exchanges, not just Binance, right? We take, I believe, like 8 to 10 exchanges outside of Binance. We take the average spot price for the given contract. For instance, BTC, if it's BTC USDT futures perpetual contract, and we take that into account in the calculation of the mark price. Why do we do that? We do that for a very good reason, is because whenever you get liquidated or whenever you calculate your P&L, it is the system calculates it using a price, right? So for instance, you're going to have a liquidation price telling you that at this very price, like for instance, if Bitcoin goes down to a certain price, your margin will get liquidated. Okay. And the problem, if we take the last price for this calculation, is that some players in the market that have like wrong intention can try to manipulate the price and make the price go down very quickly, which will cause a lot of liquidations and which will not actually reflect the actual price, average price of the contract. So in order to be fair to traders, in order to limit the risk of liquidation arising from market manipulation, all futures exchange or crypto, most of them use the mark price to calculate liquidations and P&L and unrealized P&L, basically. So you can see the mark price as a color that we put on the last price in order to make sure that the price doesn't diverge suddenly too much from the actual price of the futures. Basically, it's actually a risk control thing that is specific to future to protect the traders. By the way, I strongly encourage you guys to look and girls to look at the recent FAQ article. I think those are blog articles actually that were published on the Binance Academy website about the difference between mark price and last price, because those are extremely insightful and it's extremely well explained. So yeah, if you want to dig deeper, look it up. Yeah, you're gonna learn a ton.
That is also on our Binance South Africa Facebook, guys. If you scroll down, I think it was in December or early January, we did have a whole explanation, a blog post on USDS versus coin margin. We also had the last versus mark price. So scroll down a bit on the Facebook. You'll be able to find out some more information there. We are going to close the questions now. I have dropped the link in the chat for the campaign. Before we say goodbye, I'm going to ask Jack to just one more time explain exactly what the campaign is to everyone, just so that we're all aware there is an opportunity here, guys. We are running a promotion, and Jack will elaborate a little bit more on that before we do end the call.
Absolutely, guys. This is an opportunity for you to double your deposit first. So whenever you open your futures accounts, you deposit 5 USDT, and then you get a 5 USDT trading voucher automatically credited to your account, I believe within 7 days, and that you can use to trade, right? You cannot withdraw it. I want to be clear about this, but you can use it as a margin to trade futures contracts. So it's a good way for you to get started in trading future. And second bonus voucher is when you trade over a volume of 500 USDT using leverage, then you get a second bonus voucher of 5 USDT. And for users that already have futures accounts open but have never traded, we automatically disburse 5 USDT voucher to make your first trade as well.
Perfect, guys. So there you have it. You can get many different vouchers, bonuses, etc., whatever you want to call them, for trading futures. I just want to clarify with you, Jack, when you say you can't withdraw that 5 USDT, with regards to, for instance, if I deposit 10 USDT and then put that 5 USD on top, now I have 15 USDT, and then I go trade futures, will I be able to withdraw my profits minus that 5 USDT, or does that 5 USDT always, whatever profits is made from it, are also gone?
Of course, Doug. You can withdraw everything, all of your profit. You just cannot withdraw that 5 USDT initial voucher. But whatever you deposit and whatever you profit you make is naturally withdrawable.
Okay, perfect. So there you have it, guys. You can actually leverage a bit more if you want to. You can go into a higher position with that 5 USDT. You can literally double your position from 5 to 10 USDT and withdraw all the profits. You just cannot take out that 5 USDT reward voucher. Perfect. That is it from me tonight, Jack. It was lovely having you here. I'm sure the community enjoyed it. I'm sure everyone's questions got answered. It was great having you here, and I hope to see you again for newbie walkthroughs, options, AMAs. We'll see in the future, I guess.
Likewise, guys. Thanks a lot, Doug, for having me, and trade safe.
Thanks, everyone, for joining. We will see you in the next one. We will have the newbie walkthrough next week. That will be specifically based on futures. We'll be walking you through how to make your first trade, how to put funds in your futures funding wallet, etc. So we will be going through all of that next week. So those of you who want to go do a bit of research before then, feel free to do so using the Binance Academy. As Jack mentioned, there are lovely articles on there. There's very educational articles on there. And then when we go through the newbie walkthrough, if you have deposited, we can go through using that 5 USDT voucher. We can actually go through a trade together, so on and so forth. Do the physical form, not the talking form, and hopefully take away this scaredness of futures and get you into trading futures in the future. Thank you for joining us. It was a great session, and we will see you in the next one. Cheers, everyone.